And that's really just showing how inflation actually devalued the value of your debt, right, relative to the value of the asset. That house is still a house. It still houses a family. It hasn't really changed in terms of its purpose and its intrinsic value since 1965.
Christian Spielvogel, how are you today, my friend? Welcome to the podcast.
Doing absolutely great, Russ. Pleasure to be here.
And just, in full transparency and honesty, thank you for giving me the phonetic way to pronunciate your last name before we got on here. I've known you we were just chatting off air and we were going on all this wonderful conversation topic. How long have we known each other for?
Boy, not as long as I think I would have liked to, because I've rather gotten to like you over time, right? And I'd say that I think I first ran into you probably about 5 years ago, I guess, maybe 6 years ago.
And I'm sitting there going, oh, geez, I know him. I'm a fan. I love his work. And I'm sitting there going, and then his last name, and I look at it, and I overthink it. And then when you told me how to phonetically say it, Spielvogel, it actually makes sense. It really does when you do look at it.
Well, I think so, but it's been my name my whole life. So,
is it German background?
Sort of. So, my parents are from France.
Okay.
My father's parents were from Poland, but they were from the sort of Germanic side of Poland. If you go back in history, so it's kind of a German name that's been polarized, if you will, or policized, or hence the Z in the middle of it.
Nice. So now, just for course of action of people who maybe are my audience that don't know who you are, where you live, where are you at the moment?
Yeah, so we're based in Ottawa. We live and work downtown Ottawa. And we also have an office in Carleton Place, which is just outside of Ottawa. And we've recently started to establish ourselves in another little town called Allemont in the area.
How long have you been in the Ottawa area?
Oh, boy. I think I moved here in the late 80s. So I'm originally from Halifax. So I grew up there and found myself following the tech path and went to work for a company called Bell Northern Research. Had no idea what they did, but they had the word research in the name. And I thought that would be super cool. So I followed that and ended up in Ottawa.
Nice. Well, you're only like in your late 30s now, right? Is that not correct? So you can't have moved to Ottawa. You were born in Ottawa, right? So
well, that's it, right? Combination of tech and real estate has given me all this gray hair. I'm actually much younger than I look.
Well, it was funny. Speaking of aging, I was one of my wife's and one of our favorite artists is we both love Bryan Adams. Like my wife she had a crush on him when she was in high school. Burnaby girl, Bryan Adams, this local area. And we were listening to the radio this morning and they were having one of those, on Thursday night, we're going to, it's the anniversary of Cuts Like a Knife when it first came out and stuff. I'm going to play it in its entirety. And it's awesome. They go, we're celebrating its 41st birthday of when it first came out. And my wife both and I looked at each other and we're going, oh my goodness, Cuts Like a Knife came out 41 years ago.
Yeah. Those moments, you just kind of turn the radio down.
Yeah, exactly. We both had a little chuckle about that, but it still didn't deter our love for Bryan Adams.
No, but like you or like me, I'm sure you have even as much energy or more energy than you did when you were younger. I'm just constantly energized by what we're doing.
Oh, it's fun. There isn't a day that goes by. Don't get me wrong. It is extremely hard and it's extremely difficult and it is extremely stressful and it extremely, I have no idea what I'm doing some days, but at the same time, I wouldn't want to do another thing. I'm just tickle pink every day.
Yeah, absolutely. Right. It's, some people refer to it as comfort zone, fear zone, learning zone and growth zone. So I love living in the fear zone.
Yep.
Okay. So if I'm in the comfort zone, I get bored so fast.
Yeah.
So I always like to push limits and do things that I'm not completely sure I can do. Right. And I've always been like that. So, I believe you're like that.
Well, it's one of the best diet programs ever is stress. Stress is a really good diet, isn't it? How do you have so much energy? Yeah, I'm just always unstressed.
That's right. Exactly. This fear of dying keeps you motivated, right?
Exactly. Yeah, I can't stop, or else, like, if I ever stopped and thought about, well, geez, contemplate life, I go, wow, uh, this is a foreign concept.
Yeah, yeah, exactly. No, I've tried to take downtime. It's just not for me.
Yep.
I can do so. Earlier this year, my sister arranged a trip for her family, my father. We wanted to take my father to Cuba for a week, and I was good for about 2 days. Right by the third day, I was just bored to tears. I was trying to find anything to do. I went on all the little events that they had, everything that was going to get done. But I was just bored. And I actually couldn't wait to get home.
Yeah.
Right. And I know that sounds really weird to most people that are listening right now, but I just have to do stuff.
Yeah, it was kind of cute for a little while seeing all the 1950s cars that are everywhere and all the kind of stuff. And it's wow, it's like stepping back in time. And then after the second day, it's like, okay, well, now what?
Yeah, exactly. Exactly.
So Ottawa, what's going on weather-wise out in Ottawa? And we're going to talk a little bit about the market and what you're doing. You have a different business model than most people I've interviewed on my show, and I really want to kind of lean into that. But what's happening out in Ottawa? And we're recording this in the winter of 2024. What's going on out there?
Well, I mean, it's snowy as you'd expect. We had sort of a mild start, and but then winter just came in quite quickly, and we've had probably about just shy of 60 centimeters in just over a week. Normally, that gets spread out a little bit more. So, fortunately, I have people who remove snow, so I don't have to worry about that anymore. I just have to dry it in the thing.
Yeah.
And so it's a beautiful winter wonderland right now. So people hear snow and they think, oh God, this just sounds like a lot of work. Well, if you've got it all under control, it's gorgeous.
Yeah.
Absolutely beautiful here.
And if you're a cross country skier or like to get outside and things like that, that's wonderful. And we're having one of those snow days out here in Vancouver. Like that's why I had to wear my Aloha shirt here today, just to remind myself of something warm and tropical. Let's put it this way. Here's the best analogy I give of a day we're having in Vancouver. It's lots of snow. We don't get snow. It's like I let the dog go to the door to go outside. He takes one look outside and he looks around and he goes, no, I'll just come and poop inside. Don't worry.
Yeah, I have a little chihuahua who's like that as well, right? He's just the dog alarm. So I refer to him as our head of security.
Yeah.
And so he makes a lot of noise and he always says, okay, Dad, I want to go outside. I want to go outside, right? Open the door. He goes outside. He goes, I want to go in. I want to go in.
Yeah, I hear you. Now, I've had some people tell me, and to be honest, I care, but I don't care. Is a lot of people sit there and go, well, Russell, get right to the real estate stuff. Let's learn all this kind of stuff. Stop talking the chit chat and get to know each other. Well, I find sometimes in the golden nuggets of just getting to know somebody is where the true essence of a person, the true essence of inspiration comes from. And that's one of the reasons why I wanted to have this conversation with you, is I believe in surrounding myself with people much smarter than I am. And especially a combination. Now, I'm just going to pump your tires here for a second, Christian. You're one of those people that you are extremely intelligent. Like you blow my mind when I read a post and your analysis on things. But most people of that extreme intelligence don't do anything. They're all book smart. They sit on their hands and they analyze things and they pro and con and they what if and on this hand, on that hand, on the other hand, and how many hands do you got? It's like, but you're one of those people that actually does things on top of your intellect as well. So there is a question there. And the question is what was kind of the moment for you that you wanted to really kind of get into this real estate thing? Was there a moment? Was there kind of an evolution? Was there a revolution? What was kind of your moment to get into real estate?
Good question. And I think the first part was I worked in private sector. So in the private sector, we don't have pension plans. And while I earned a good salary, I didn't have a solid way of actually retiring and getting plans. So my wife and I thought, we did stuff with the stock market, we did stuff with mutual funds, but it was not terribly exciting. And I never had a lot of confidence that it was going to get me to where I needed to be. And I talked to an older gentleman who I ended up buying a property from much later on. I talked to him, and he used to be a school teacher. And he said to me, Christian, he said, I've invested in a lot of things. Nothing has done better than real estate ever. Right. And that stuck with me. My wife was always interested in real estate. So she was, this was something she would like to do anyway. And then one day, a purpose-built fourplex right next to my house came up for sale. And I just looked at my wife. I said, "Should we do it?" She said, "Sure, let's do it." And a number of people have heard this story before, but it's fundamentally I sat down with my analytical approach to everything, and I worked through all of the math associated with it because we were a single income family, and running our budget pretty tight to the line, to be perfectly honest. And we needed to try and figure out if I was going to be able to afford this property. So I figured out all the things that might go wrong, and then figured out how I was going to deal with it. If those issues were happening. So I was doing sensitivity analysis, everything. And in my mind, it wasn't a question of trying to convince myself why I wouldn't do it. I didn't see that as an option. I felt I needed to do it, but I also needed to figure out how to make sure that I was protecting myself. And so that was the very first real estate transaction that was purposeful. And that was back in 2005. And then the next, so we started acquiring assets while I was still doing my career. And then in 2017, I decided to make the pivot towards doing this on a full-time basis. And the real catalyst there, there was a lot of stuff. I was getting bored with my job. Our real estate portfolio was getting to be a lot larger than I could really deal with, and my day job. But the real catalyst was that my elder daughter had some serious mental health issues and had developed some addiction issues and so on. And my wife just couldn't deal with it on her own anymore. And I had to make a very conscious decision to focus on getting her better. And so I quit my day job and started focusing on the real estate piece, restructured our portfolio completely to optimize it for cash flow because now I didn't have a salary coming in anymore, and worked on figuring out how to get more capital and working capital out of the existing portfolio and then build this thing into, give it a bit of momentum. So I'd say that this is something I was ultimately leading to. I probably should have started a lot earlier. My daughter with her issues really kind of gave me the kick in the butt that gave me the latitude to deal with her and make the career change that I think I needed to do at that time. But that's kind of the Cole's Notes of what happened.
Well, and I'm old enough to know what Cole's Notes is. It's funny, these references I have with people, and I use these references all the time, and people sometimes they look at me like a deer in the headlight with things. And, one time I was at the audio store getting a thing fixed, and the young fellow came out from the back and said, "Yeah, mister, we fixed this for you." That was probably a bad imitation. I go, "What was wrong with it?" He goes, "Oh, it was a capacitor issue." And I said, "Oh, geez, I sure hope they fixed the flux capacitor because we want to put 1.72 gigawatts of electricity through that." And he just kind of looked at me, and I said, "You had no idea what I just referenced, did you?" Do you reference the flux capacitor, 1.7 gigawatts of electricity?
I try not to on a regular basis, but I know what you're talking about.
Good. Well, it's from Back to the Future, obviously, right?
Yeah,
Another good Canadian actor, Michael J. Fox. But anyways, right. The funny is I do understand Cole's Notes, by the way. So nowadays it's just people, our kids will be sitting there go, "Cole's Notes, you mean Chat GPT or AI?" That's how we get our book summaries now to us.
Is it the new acronym TLDR for that?
Too long, didn't read. Yeah.
Yeah.
So thank you. That was and I think there's an awful lot more to that story as well. And I just, thank you for sharing that as well. I'm a very big proponent on mental health, on, being part of, it's being part of my life for many, many years. I've, dealt with it. I've treated it, and I went a different route than a lot of people go. But it's been a dark friend of mine since my early 20s. And every so often, they come back and visit, and I've come to embrace it. I've come to embrace it, and I've come to dance with it in many respects, because it is who I am. And as a matter of fact, it's actually potentially a superpower, I believe, in many respects. But really, your story, if I was to summarize it, came down to sometimes we have those moments where we have either inspiration or desperation. You had a little bit of inspiration when you first started, and you had the fourplex, and you had this kind of stuff, and you were getting up the way, and then all of a sudden you had one of those moments of, yeah, we got to figure this shit out, and you made it work.
Yeah, absolutely. And I didn't really feel like it was a choice at the time. It was something that needed to be done. And I was, I'd amassed enough in the real estate side as a sideline to be able to do that. And, we didn't take a lot of training or anything at the time. So we didn't get smarter, if you will, like till probably, 2015 timeframe, maybe 2014, where we started learning from a lot of people and figuring out and taking courses and so on in order to find ways to become more efficient at it. And so while I was doing fine as I was before, by taking some training, some amount of coaching, et cetera, it really made me sharper at what I was doing from a business perspective. So that I ended up not just collecting real estate, but figuring out how to do it really super well. And then I combined that with my business experience that I got in corporate, because I'd evolved to becoming a general manager of an R&D division, right? So, you have to have a business acumen for dealing with that. And I applied a lot of the same techniques to this, so that the investment business that we do now is run very much like, well, it is a business. It's not like a business, it is a business. And we put things like operating plans in place, strategic plans. We have a cash flow plan. We have risk management plans, et cetera. So we put a lot of formalism into it. And that's what allows us to be successful. And, as I say to people, I don't speculate with real estate. I don't buy something with the hope that it's going to improve. When I buy something, I know precisely how I'm going to make money. Okay. It's not a question mark. It's not, I hope to do this. It's, I will tell you, I'm buying this. This is when it's going, I'm either buying with cash flow now or the line of sight to cash flow. But regardless, I have a plan for how it's going to cash flow and how the cash flow is going to improve in the business, and what I'm going to do in order to release more working capital to generate, to put it into our working capital pool.
Yep.
And continue to grow the business overall. But it is a highly deterministic process. And I think, a lot of people listening to this need to understand that in their investment planning and what they're doing, whether it's in real estate or something else, is every investment that you make must be deterministic. Must know how you're making your money.
Yeah. Well, so in many respects, don't take this negatively. It's actually meant as a real positive. You're a unicorn in this game of real estate for a lot of people, for real estate investors, and you're living the dream. Meaning unicorn meaning that you're living off the cash flow from the properties. And as I say that, Christian's going, well, isn't that what we're supposed to do? Right? Isn't that the goal? And the thing is, everybody has that goal, right? And I imagine 90% of my audience that's listening to this right now, most are real estate investors. They're all sitting there going, that's what I'm working towards. I'm working towards a point where I can pay myself out of the operations of the business. I can work full time and be a real estate investor. I have, a runway where I know where potentially I can sell and divest and stuff like that. So the conversation I want to turn towards is, don't take this the wrong way. How the hell do you do that, brother?
Just for the record, I don't take anything the wrong way, so I'm a pretty easygoing guy. So you could tell me I'm a total jerk.
I'm in awe, because I'm actually sitting here. I'm sitting there going, I got my cup of tea, and I'm sitting there ready to enlighten me, my friend. Now I know there was a question there, and that's
Speaking of tea,
exactly.
Just the right angle here.
Yeah.
Keep calm and invest in real estate.
But really, all joking aside, is and I know you have some things to share, and that's a big giant onion that can literally take us probably 6 months to really unpack, to really do. But if you were just to give me some, how are you able to do that? Like, how do you plan this out? How are you able to, does it all start with, I'm going to shut up here in a second because I think I'm trying to answer it. But I guess the question is, how do you do this? How are you able to have your business operations support your business, your lifestyle, your take money out and all this kind of wonderful stuff?
Okay. So, wanted to kind of start at the beginning a little bit in terms of when I left my job and I started focusing on this. I didn't have a salary. I had to find a way. So, as you said, I now had to survive on what was a hobby business into a full time business. And the first thing I did was try to figure out how do I restructure the portfolio that I have. So I could take out equity, I could change amortization. There was a number of things that I could do in order to just optimize exactly the assets that I had. That wasn't enough. So the next thing that I did is I extracted working capital from the assets that we had. So, for, more common term, I guess I just did refis, took money out of the properties. And then I went and bought assets that were known to cash flow. So that became a priority. So that's how I got into light industrial back in 2017, I guess. And because you could buy light industrial, that would be 8, 9, 10, sometimes 11 caps, which meant that, with debt structuring it properly, you generate lots of cash flow out of those properties. So I did that. That was one way that I just set a baseline for the cash flow. So that was my first go-to, was finding those kinds of assets. Now, of course, things that have high cap rates typically don't appreciate very well. That's the trade-off. But that was okay because cash flow was the primary thing that I was looking for at the time. Now, through the pandemic, I got lucky on those assets, right? Because what happened in the pandemic is everybody needed warehouse space and light industrial space and so on. And so the cap rates went from, an average of 9 or 10 down to about 6, meaning that the value of the properties obviously went up. And that turned out to be a little post-pandemic bonus. But that's where I started. And then from there, I literally just looked for assets where even if it doesn't cash flow right away, I can execute a business plan, do something to improve the property. So clearly the property is not at highest and best use when I bought it. I have a plan to make it highest and best use. When I'm done, it's going to cash flow. And then because I've increased the value, I can take out equity. But here's the thing with finances and math is that when you take out that equity, a lot of people make the mistake of attributing that debt to the property where they did the refi. The only debt associated with that property is all the money that you actually put into it, right? Including the loans, right? So the purchase plus whatever improvements, etc. Any excess capital is now attributed to the next investment where you're putting that money. So when you're doing a return on equity assessment, etc., you need to make sure that you're evaluating that property properly. So that's really kind of the thing. And you say, well, Christian, you can't find cash flow properties right now. I have even when and good quality assets. Like if you take a look at these assets, you say, you got that to cash flow on acquisition? I go, yeah, absolutely. I purchased it properly. So right at the height of the buying frenzy, late 2022, and people are saying, you can't buy a cash flow asset. I bought a portfolio of mixed use buildings at that time that cash flowed on acquisition. There was a total of, I remember that portfolio. I think it was about 20 units in the portfolio. It's a portfolio of 2.5 buildings, if you will. And but I had $60,000 of cash flow on acquisition. When I complete the business plan, which I think will take about 4 years to do, the cash flow out of that will probably be in the order of, about $200,000 of annual cash flow. So that was a purposeful acquisition at that time. I bought another asset last week. They're saying interest rates are too high. You can't buy assets right now. Interest rates are too high. The cool thing about when interest rates are high is you can buy properties at a cheaper price. And people seem to forget that prices do go down when interest rates go up. And I bought a toxic asset, if you will, right? So You know, who in their right mind would buy office space right now? Well, I did. And you know what? The building is full. And I have no problem with it because of the way it's structured. On acquisition, it will cash flow $30,000 a year. And it has a bit of upside in it. That one I jokingly refer to as I bought it. It's a cash flowing piece of jewelry because it's actually a really beautiful building. But and it doesn't have a lot more upside, but it still met the base of my deal thesis, which is on acquisition at cash.
Wow, holy moly! Hang on a sec here, Christian. You've been just on fire, my brother. I'm sitting there going, geez, it's starting to melt the snow outside here. We just got with all the bombs you've been dropping here, my friend. Wow. Okay. So where do we even take this? So one thing I heard very, very clearly to you, and you can correct me if I didn't hear this correctly, the variable you are always solving for, the X, is cash flow. That's your X. That's the variable you're solving for. And then when you sit there and you go, when I'm going to refinance something, I don't care how much, I care how much I can pull out, but at the end of the day, I'm not going to sacrifice my cash flow in order to do that. However, you also look at the acquisition of the next place to roll into the cash flow picture at the same time too, and you're okay to maybe take one asset down to fairly tighter margins with opportunity for growth to invest into something that may have greater cash flow amongst the total. Would that be a start?
Oh, sort of. So the first priority is absolutely, you're right, is cash flow. And why? Because that's how you scale a business. If you're negative cash flow, you can't afford to fund your operations.
But Christian, negative cash flow, you can make up for it in volume. Oh, hang on a sec here. No, maybe, hang on. More like, sorry.
So you don't need I think you should add a laugh track.
I should have like hang on, maybe I should have like the, there you go, that's better.
There we go. Yeah, absolutely. Negative cash flow, you make it up in volume. That's the way to crash and burn so fast.
Yeah. Sorry, I didn't mean to disrupt you there. I just saw Shecky Green over here saw an opening, had to try to get some comedic relief in here.
Well, this is hilarious. This is good.
So you always solving for the cash flow of the operation, and that's just good business, isn't that? Not business 101 is to never have to potentially sell, have more. The chunk of money coming in is bigger than the chunk of money going out.
Yeah,
I call it the chunka theory.
That's absolutely right. So it's cash flow allows you to scale. So if you're adding new cash flow, right, then you can hire people to do work that will allow you to scale. If you're negative cash flow, you have to find a source of funds to be able to deal with that deficit. So the only way you could really do it at any scale is to be trying to find, basically borrow from your future capital and then bring it in your operations. But that slows you down in terms of what you want to do from a scaling perspective. So I really separate the concept. We call it cash flow and new working capital, but you can also refer to it as your income statement versus your balance sheet. And so I don't steal from my balance sheet to fund my operations. I don't, right? So everything has to stand on its own. It has to have its own income statement. It has to have, cash flow contribution. I will buy some properties that don't cash flow, but they're strategic in nature. There might be some land banking, et cetera, but that's a conscious business decision. It's a strategic decision. And then development projects, they're always funded on the balance sheet. So it's whatever, the carrying costs, all that stuff is part of the debt that's associated with the development or redevelopment project that you're doing. When you do the refinance at the end, you're paying back all of that, interim debt, if you will. And now that property holds that new debt. And when you're done, if you've done it right, it's generating cash flow for you to add to your operations at that point in time. So that's why I say line of sight to cash flow.
Yeah. So you don't have, well, obviously it's a bad thing. Is we always have fear, and we always want things to turn out, and there's always some kind of a fear. I think if you don't have fear, you're not human. But you're not worried too much about buying something that has some negative cash flow, taking significant debt on it, if it has a runway to get to an end target of a wonderful payout in a cash flowing asset. Like you don't just analyze it based on, well, they do this and the value lift and it's going to be this at the end. But you like I said, you look at cash flow first. If this doesn't generate some decent cash flow by the time the project's done, yeah, I'll pass. Thank you.
Yeah, that's right. It has to meet my objectives for the end completion. So I've taken on assets where they're absolutely negative cash flow right at the beginning. I know that I'm going to have to maybe partially demolish the building. I'm going to have to put a lot of money into it. But it's a business case, right? And there's an end in that. And it's exactly as you said, when I'm done, it's going to generate cash flow to our business. And it's ideally going to generate new working capital that we can use, not just equity that's stuck in the property.
Oh, wow. That's a really different way of, it shouldn't be different. It's maybe different to what I've looked at is not only does it generate cash flow at the end, it actually generates return of all the capital. And it generates some new capital to work on the next project.
That's right. So that's what I'm always targeting. If sometimes you miss a little bit and you end up with some stuck equity in there, and you can refi some of the debt that you put into it, et cetera, and you're left with a little bit of equity stuck in the project. But my objective is always to try and find a way to finish the project where none of the original capital that I put into it is left in the project. So it's now at the end of the project, it's carrying itself. And I've released all the working capital that I put into it at the beginning, including like my down payment, any construction, redevelopment costs, et cetera. And I pull that back out. And if you want to call it the unicorn, if you will, is to find ones where you can get more than that. And I've done that a lot of times where you generate new working capital. And every time you generate new working capital, your working capital pool gets bigger and bigger and bigger, and you can take on bigger projects and bigger asset acquisitions, et cetera.
Wow! So if I was just summarize what I just heard was the trifecta of when you analyze an asset, trying to get into your brain because it's hopefully there's room for all of us in there.
Yes, I know.
So essentially, you sit there and go, okay, here's my checklist, the 3 trifecta. It needs to be after I've got this asset, after I've normalized it to the process of getting my team in place and things like that, it has to cash flow. Number 2 is I have to be able to pull out the working capital that I put in. And number 3, it has to be able to generate more capital that I can deploy into another asset down the road.
Yeah, that is the holy trinity.
And would that be in kind of the order for you as well? Yes. Or are they all kind of one, they're all number 1? In essence.
No.
Yeah.
That was a very good summary. And that is the order in which that I work things. So
well, feel free to use I like a good Venn diagram, if you will. Feel free to put those things all together and we can create that. And I'm looking forward to seeing this on your website next of the three pillars of the way the model that you invest in.
We'll call it the Russ and Christian Venn diagram.
There you go.
Because you added a lot of value in that.
So first of all, I'm going to just switch over here quickly. Your website.
Yep.
How do you pronunciate? Is that Alferus?
Aliferous.
What does that mean? What does Aliferus mean?
Wings. It's with wings. That's why you see the little wings on the little character there.
Okay. Very good.
And, at the time, so there's actually a method to the madness. So I was trying to find a name that was meaningful and at the same time that no one else was likely to have had, because I wanted to register the trademark. So that way, this is also another asset, just like real estate. It's another asset where I own the name Aliferous, anything to do with real estate related stuff, and I can make Aliferous anything. I can Aliferous Consulting, Aliferous Real Estate, Aliferous Academy, Aliferous, whatever you want to do. So, because I own the root trademark, and that's why there's the registered trademark on it.
Oh, nice.
And
nice.
With Wings was really very much about, taking flight, if you will.
Love it. Now, just gang, I'm just jumping on. I have Christian's website up here, and if you guys get a chance to jump onto his blog and some of his, they're some of the most well thought out, well written content pieces that I've seen in a long time. I highly encourage it. Your research and analysis on variable versus fixed, your rent controls analysis, all those kind of things. Highly encourage you to check that out if you haven't you haven't checked that out in the past here as well. So, well, just well done with a lot of that. I imagine, and I know how long it takes to put a good piece of content together too, right? It's definitely not a put a good chat GPT prompt in and let it spit out a whole bunch of gobbledygook that just, like, honestly, I can see it a mile away when people make those posts out there. It's almost like one response was good prompt, right, that you put into the AI, if you will.
Yeah, no, I completely agree with you. And if I publish something, I want it to be meaningful.
Yeah.
Because I'm not trying to do anything other than to help people. Like when I publish this stuff, I as you know, I don't raise capital. So I'm not doing this. I'm not even on this podcast because I'm hoping somebody's going to come to me and say, "Oh, Christian, I want to take your money." Yeah, or sorry, I want you to take my money.
Well, I'm sure somebody will reach out to you and sit there and go, well, since you're offering your money, Christian.
Yeah, exactly. That's right. Yeah, that was totally misspoken. But no, just I'm not trying to raise money in that respect. I mean, I raise debt, obviously, because that's an essential tool. And that's a whole other avenue of discussion if we want to talk about how debt and inflation are super combinations together. But no, I raise debt. I don't raise capital. We're fully self-capitalized. So I've always had a desire to try and kind of give back to the community, help others. I don't like to see people in trouble. And that's why I'm involved with things like the Ottawa Real Estate Investors Organization. I'm on the board there. I'm also involved in the Eastern Ontario Landlord Organization, which is involved in lobbying at municipal and to a little bit degree to the provincial level. And then I've been involved in CFAA as well, where I've lobbied at the federal level and was on the parliamentary committee for housing, middle of last year.
Yeah.
But it's all, passion of mine to try and do the right thing for people.
No, I agree. And obviously, I probably don't have to ask this. I probably know is you have obviously an entrepreneurial, capitalistic heart and it kind of, a leaning, I would put it this way, a leaning towards that. And I would imagine living in Ottawa, is it like your penance or something like that to have to live in Ottawa as an entrepreneur with a capitalistic jag?
Only in my neighborhood, which tends to vote very far left all the time. So, but no, Ottawa is absolutely beautiful. I grew up, as I said, in Halifax, and Halifax is a beautiful city as well. But Ottawa is just because everybody associates Ottawa with Parliament.
Yeah.
Okay. But Ottawa is just an absolutely gorgeous city. It punches well above its weight. When you combine it with Gatineau, which is just across the river, we're looking at about 1.3, 1.4 million people in the area. You have all the embassies and consulates here. So you end up with a big cultural diversity in terms of not just culture, but food, etc. We've got a major high-tech presence. The largest tech park in Canada is on the west side of Ottawa. And from a nature perspective, you just couldn't ask for better, except maybe with the mountains that you have, right? So we don't have those beautiful mountains that BC and Alberta have. But we have some molehills, right? And they're really pretty.
Yeah. I think everybody takes cheap shots at Ottawa just because we all think it is the Parliament. But there are some incredible opportunities there, and that's actually what I wanted to pivot our conversation into. As far as I understand, you primarily invest in Ottawa and area. Do you have investments outside, or where do you primarily invest?
Yeah, it's mostly Eastern Ontario. So we focus on Ottawa and the tier 2 towns around Ottawa. Halifax is another town that other than that, I grew up there. Halifax to me is a solid area for investing. Solid economic foundations. Lots of international trade goes through Halifax, and there's a lot of redevelopment that's happening there. So with all of those foundations, you're seeing vacancy rates being ultra low there. And the real estate market doing extremely well, and it's sustainable. So we're not talking another Moncton, right? Like Moncton has its qualities, if you will. It's actually a nice area. It's a hub within the Maritimes, just where it's positioned from a transport perspective. But a lot of the lift we're seeing in Moncton is rural to urban migration. So it's not got the economic underpinnings that make it a long-term success. And I think a lot of people likely see, could easily get burned there if they hang out there for too long. But Halifax, by contrast, in the Maritimes, is, in fact, quite frankly, Halifax, if I look at it as a city across the country, is absolutely solid from an economics foundation. And it's an area that I do plan to invest in. And I missed a couple of good opportunities down there, right, that I was just about to pull the trigger on. And then pandemic. And, at the time, I was like, you know what? I don't know what the hell's going to happen here. I wanted to preserve my capital and pull back on those at the time.
Nice.
My instincts were right,
Yep.
though, Russ.
Yep.
I should have followed through on those ones, honestly.
Well, sometimes our gut is there for a reason and tells us what we need to hear, right? So
it does. But going back to Ottawa is, a lot of people say it's relatively boring from an investment perspective, right? But boring creates predictability. And the nice thing about Ottawa is, you're not going to get the ups and downs that you would see in, say, Toronto, right? Where everything goes up and then everything comes down and then everything goes back up and everything goes down. It's pretty solid here. And there's, I have an economic theory as to why, and I've documented it a number of times, but it really revolves around the balance of a public sector and a private sector in this city. And the public service is obviously a dominant economic contributor here. And the private sector is significant as well, the high tech being the biggest private sector contribution. And we know what happens as, if we start to go into a recession, right, and private sector starts to pull back, public sector usually tries to stimulate the economy, generate a deficit, which usually leads to employment in government-centered towns, such as Ottawa. So it offsets any declines we get in the private sector. But then normally what happens is if the economy becomes strong and the private sector does well, that's when the federal government and provincial governments start to pull back on that deficit spending, try to go back to balance or even surpluses. And they pull back. And when they shed, what happens is a lot of people become entrepreneurs because they don't want to be jobless and they're not just going to move to the private sector. So it creates a bit of an engine of new entrepreneurship in the area.
Yeah.
What we end up with is this sort of, seesawing, if you will, of private versus public sector that keeps, on average, everything kind of balanced. And then what's happened since about 2017, when our current government, the Trudeau government, came into power, the private sector was doing really well, and the federal government decided to do deficit spending anyway. Okay, and so now we have two strong engines, and going right up into 2019, the city was just on absolute fire economically. We couldn't fill jobs fast enough, and the economy was just getting super strong.
Yeah.
So that's it. I mean, this whole area is on a very stable economic foundation.
Yeah. Well, thank you very much. That's awesome. I'm a firm believer in sometimes government towns get the bad rap on things, but I'll tell you one thing that government towns do is a lot of the do that's done is they cut off a lot of the highs and they cut off a lot of the lows, and there's the band, but the delta between the high and the low is actually very tight. Mm-hmm. And and let's put it this way: during a government of big government, if they are big government, that's good for a government town, right? Because they hire more employees, and more employees potentially can, and more committees and more, consultants and all that kind of stuff, and they hire all those kind of things. Or if they cut back and maybe there's more of an entrepreneurial government, maybe it turns people into more, they hire a lot of that stuff out, right? To outside firms and stuff like that. So yeah, I'm a fan of, that's one of the reasons why I like Edmonton over Calgary a little bit, is the delta between the high and the low. And also, most people think is, it's not diverse. Well, when you actually look at it, and I'm just going to use Edmonton as an example, 32% of Edmonton's jobs are not, everyone says oil and gas. No, it's actually education, healthcare, and government. Are a third of all the jobs in the city are essentially attached to the government.
Yeah, completely agree. Edmonton's a solid town. I mean, I haven't done a ton of research in Edmonton, but I've done a lot of superficial research in there. And I like what I see there, honestly. So I just don't invest there.
Yeah, no, it has its challenges like any place, and it has its opportunities, and that's one of the reasons why I want to have a conversation with you, is because I know you study the markets. And speaking of that, so you kind of like, you have your areas. If somebody came to you and said, Christian, I know you have nothing to sell me, you're not raising any capital, what is the opportunities that you are looking on? Like, what are the trends that you are really sinking your teeth into, and you're going to sit and go, that's the next 7 years, I'm going to go hardcore into this trend? What is that for you right now?
Well, if I was to, because I tend to go with the flow. So I watch the market and what's going on, and I follow the money. I don't get caught up in the fads. Everybody's saying multifamily. I've been a lot of multifamily. It's great, right? But I don't follow a particular investment asset class, if you will, purely because, everybody's fanning the flames and then there's a lot of excitement. I literally just look for, okay, where's the money? So why did I get into light industrial in 2017? Nobody was doing it. Everybody was like, what? What are you doing? I'm following the money. That's where the money is. So I bought a lot of multifamily. What I've been finding right now is a bit of a quiet space where people aren't looking hard enough, is in mixed use properties. And by that, I mean main streets, retail on the main floor, residential up above. And the people that are chasing multifamily aren't touching those mixed use assets because they get intimidated by the commercial space within the building. But done properly, those mixed use buildings, especially if they're bought on main streets themselves, so they have to be prominent locations where they're always filled first when it comes to retailers, et cetera. So you're not as subject to, recessionary issues that might happen, which might leave vacancies. Main streets are almost always filled. So and then the other thing that I'm looking for in those mixed use properties is I want them to be insurable by CMHC for my refis. And so CMHC will insure mixed use properties so long as the commercial portion is 30% or less of the overall leasable area.
Nice.
So I can take a property that is, say, let's call it a 3-story building. First floor is commercial, the rest are residential. And as long as the floor plans line up properly and that commercial space is less than 30% of the overall leasable area, CMHC will insure it. And I can get the preferential benefits of a multifamily building, but I now have it on my mixed use building.
Yeah, it's so much nicer shopping to lenders when you have a certificate of insurance that says that if you don't pay, the government will step in and remediate and will pay any shortfalls on your behalf.
100%, right? And you're touching on something that a lot of people don't realize too, is because most people, they'll go to a lender and they're going to get the lender to run that certificate for them. So they're going to be the liaison to CMHC and so on. But you can find people that will actually run the COI, or the certificate of insurance, for you. And you have this, as you said, you have your certificate in your hand. You're going to the lenders now and saying, who wants it?
Yep.
How much are you willing to give me as a discount and better terms, right, for this certificate?
Yeah, and not only that, is if you can actually start stacking a few of these together, you can sit there and go, actually, there's 3 applications here that all have certificates. Who wants to bid on all 3 of them, type of thing?
Yeah.
Right. And
exactly.
All of a sudden, the pencil gets a little sharper when they start knowing that there might be a few more lending opportunities there too. And as well, it's, the crazy thing in the commercial lending world, which I'm learning a lot myself, is it's funny how the more zeros you add to the loan, more people want to lend.
Yeah. Well,
and zeros on the left side of the decimal. Let's make sure we clarify that, right?
Yeah, that's right. It's 0.000001.
Yeah.
Yeah. No, and that's what I did at the beginning of 2023. I actually started in the back end of 2022. So when interest rates were going crazy, I got really nervous about our banking sector. I was worried about their liquidity. I was worried about the fact that I knew I had development projects on the fly. I needed to make sure I had cash for them. And I just went out and I refied everything in sight. And it was basically what you're saying. So it's just offering them multiple properties at the same time, all with a COI.
Yep.
And it's a really wonderful discussion with lenders when you have your ducks in a row.
Yeah, and speaking of ducks in a row, is like you sit there and I imagine you've turned a lot of it into cash at the same time, just for protection and stuff like that. And I could just imagine Christian, like the Scrooge McDuck, going into his vault, swimming the backstroke in the mountains of cash and stuff like that. You would probably,
it felt like that a year ago, yeah, for sure.
You would probably understand the reference there, right?
Yes.
Okay, so thank you for that. I appreciate that insight onto the mixed use opportunity, but taking it another step. Like if I was sitting there, and some just popped into mind, would be if I'm sitting there and if I know my city is going to reinvest and revitalize their downtown core in many respects. Let's take an example, and I could be completely wrong. Let's say Thunder Bay, for example. Let's say Thunder Bay wants to revitalize its downtown core. It has a whole bunch of old saloons and, tattoo shops, and nothing against tattoo shops, but they want to revitalize it. There might be a really good opportunity for somebody to go in there and buy a mixed-use commercial thing downtown. I would bet the city would be all over giving you some nice incentives and maybe some fast tracking of permitting and stuff like that too.
Yeah, for sure. And those are all absolutely good points. The other thing that we have to keep in mind is when there's revitalization going on is that you have to be part of the momentum. So
don't be the starting of it, right? Well, don't try to force it.
Kind of. So if you're going to do it, you gotta be part of a bunch of stuff that's going on, or you have to have enough capital coming in that you can revitalize a whole section on your own, or at least you have a strategic plan to do so. But if you're going in buying one building out of about, say 8 or 10 blocks, and you're the only one improving the asset, you still got a pile of garbage all around you.
Yeah.
It's go well. So a friend of mine, who I'm sure you know, Victor Minash, refers to it as moving the line, right? And where you basically start with a good solid block or sector within that area, and there's a part that needs to be redeveloped. But what you do is you buy the properties that are just inside that rougher section, you redevelop that, and effectively what you've done is move the line a little further out, and then you do it again. And that's a methodology that we've used in a town called Carleton Place, where, there's the downtown sector, and then we start buying properties just on the other side of the bridge. And where some of the properties were good, some of them were really not good at all. Like they were absolute disasters, including the ones we bought. And then we fixed those all up. And now everything up to our property or properties are, considered to be a good part of town. And then we just continue to buy the rest of the block, and you just keep moving it in that direction. And, to your point, the town gets really excited about that.
Yeah.
Right. They're very supportive. They don't necessarily give you grants. Some towns do. But at least the planning office is like, what can we do for you?
Yeah, that's awesome. And I know, and sometimes being too early of an adopter on something too can actually be a little bit detrimental. I know there was an area in Edmonton that essentially, for people that know Edmonton, there used to be a municipal airport within the city of Edmonton. I think it's 400 acres, inner city Edmonton, that has just been rezoned, and the city bought it and they've repositioned everything, and they're going geothermal and solar, and they're investing all these things into walkable communities, and they're doing all this kind of stuff. And to be honest, it was too far ahead of its time at the time when they started doing it, and nobody was really taking up on it. And then all of a sudden, some really cool houses were built, and some really cool things that are geothermal and solar, and they're all, they literally actually contribute money back to the grid. And now there's there's a half a dozen houses, and then there's the next half a dozen houses, and then there's going to be a campus for the technical college is going to be on there. They're going to need probably 2,000 rooming houses there. It's funny how it took a while, but once you get that momentum, that there's some really cool opportunities in there now.
Yep. Yeah, absolutely. So but main streets, that's where I've been at.
Yep.
In downtown Ottawa, I've been focusing mostly on heritage buildings and redeveloping them. Somehow I got into heritage, maybe stupidly, I don't know, because they're a little more challenging. But I really like pretty buildings.
When you say heritage buildings, what is the play you're doing? Are they office building? Are they old hotels that turning into condos? Like what is it? Give me an example of a project you're doing in Ottawa.
Sure. So I've got a few. So one in downtown Ottawa, it's an older building, which is, interestingly enough, just outside the heritage overlay area. So I have zero obligations to maintain the heritage. I could have just raised it and then just put a brand new building there. But there's so many beautiful other beautiful buildings right in that immediate area. So I thought that would be a sin. It would be the wrong thing to do. And so it might be costing me a little bit more to do this, but I'm rehabilitating that building. I'm enhancing its architectural features on the outside. It's going to end up being a 12-unit apartment building where literally it was built in 1901. We're taking it all the way back to the bricks. It's structural brick. So we're taking it back to the bricks, completely relaying out the building and turning it into a modernized 12-unit building on the inside. But when you look at it on the outside, it's absolutely gorgeous and beautiful. So that's an example of something that we're doing in downtown Ottawa. And then I've got other buildings where, for example, in Almont, one of my favorite new towns. It's anybody who's ever watched a Hallmark movie has almost certainly seen Almont, whether they realize it or not, because a lot of the filming is done there. And so we ended up buying all of the really pretty buildings on that street. So everything on Mill Street, the main street of Almont, we own all the pretty ones. And they're also the bigger the buildings there. So the latest acquisition that we made there was the old post office. That's the most iconic building in Almont. Beautiful. It was the architect was Thomas Fuller, the same guy who did Center Block of Parliament. And he was the Dominion chief architect back in the late 1800s and 1890s when this building was built. So it's got the same colored stone that Queen's Park has in Toronto, for example. So it's that red Sussex limestone. It's got the green copper roof. It has a clock on it and a bell and all that kind of stuff. It's absolutely gorgeous. And it cash flows.
Yeah. And essentially the play that you're doing is you're taking these things, turning them into residential and residential rentals, in essence. Sometimes
So
some you sell, some you rent, or what's?
No, we always rent. So we never turn into condos. I mean, we could go down that path, but we don't. Our business is all about generating rentals. And so we just grow our rental stuff. And we have a mix of commercial and residential stuff. So we will always take a building to its highest and best use. Sometimes that's residential, sometimes it's commercial. So with this old post office building, the best use for it is actually to maintain the office usage that's in there right now. As opposed, if we were to convert it to residential, we might actually lower the value a little.
Wow. And I had a conversation with somebody the other day, and they're saying, well, why don't you take in some of your projects you're doing and turn them and just sell them? And I go, well, to be honest, the financing that we're getting for these things is so good. Why would we not? Like the government and CMHC is especially with the MLI Select program, I haven't seen financing like this, and I don't even know when, really, to the terms that they're giving for these kind of things. If you're only into the asset for, fees, in essence, and there's an opportunity that you can get your GST back out that was put into it at the same time, why would we want to sell it?
Yeah, well, it's absolutely. And I think that's generally been the model is at least when we're doing a refi and we take the capital back out, we're not being taxed on it,
Correct.
Which means that we can take that equity and we can move it forward in terms of new development and redevelopment projects and enhancing the overall assets. The worst thing is selling, right, in my opinion, because when you sell something, to your point, you're taxed on all the gains that you made there, right? Including the stuff you didn't do. So one of my pet peeves, Russ, is that let's say you take an asset and you don't do anything to it and you hold it for 10 years. it's, I guess you could say it's appreciated, but we both know that what happened is the currency got devalued. But regardless, what's happened essentially is nothing has changed about that asset. If you bought a single family home 10 years later, as long as you maintain it properly, it's still a single family home. It's worth fundamentally, intrinsically the same as it was 10 years earlier. But the government basically says, oh yeah, but you're going to get more dollars out of it relative to the dollars you put in. And they tax you on that, the capital gains tax. But it's one of the biggest scams in the world because you didn't do anything to that building, right? You did not fundamentally improve it. It is still what it used to be. All that happened was that the value of the currency got devalued and you're getting taxed on that devaluation. So that's one of my hobby horses there, Russ.
Yeah, is that maybe a good place for you to jump into? And I think you've already opened the door about your debt and inflation conversation is really with that. So in essence, you view debt as a tool to create wealth. In essence,
yeah, it is because if you follow that same logic, right, then if you have debt that inflation devalues that debt because the currency becomes devalued. So the best thing to be holding in an inflationary period is actually debt. You have to manage the interest rates, of course, right? And you have to put mitigation plans. And this is why I'm generally a fan of fixed rates, right? It offers me predictability and stability. So, but that debt that I hold in high inflationary periods, the number never changed, right? So, but it's in the old dollars that I had when I first took out that debt. So when inflation is, say, running at 10%, if I had a $100,000 loan, a year later, if inflation is still at 10%, my loan in the new dollars is about $90,000, right? And then it's about $81,000. And then after that, it's $73,000. And it just, when you're looking at the value in the, future value of those dollars. So even though the asset didn't change intrinsically in value, your debt effectively got cheaper and cheaper and cheaper. Now, the easiest way to try and put this into perspective, my parents bought their first house in 1965, and Dad told me the whole story, which I'll spare you. But he fundamentally bought it for $13,000 in 1965, and it was 100% financed. So he borrowed $13,000. Now, he did the good Canadian thing. He paid down principal and interest and so on and paid it off. And he was so happy. And he burned his mortgage when he was finally paid off and was like, hoorah. If instead he had just basically said, I'm not paying any principal and I'm just going to hold that indefinitely, and which makes a lot of sense for investments, not necessarily your personal residence, then you'd have $13,000 owed today. You could pay that off with a credit card. Okay. Back then, it was a lot of money.
Yeah.
And that's really just showing how inflation actually devalued the value of your debt, right? Relative to the value of the asset. That house is still a house. It still houses a family. It hasn't really changed in terms of its purpose and its intrinsic value since 1965.
Wow. Holy moly. Hang on a second here. I'm sleeping at the switch here. I'm just like, if for those of you that are listening, my mouth was dropping and I was like, I'm in awe. It's just, yeah, that's why I love having these conversations with people that look at things differently. Mm-hmm. Most people fear the debt, want to pay the debt off as fast as possible. And I totally agree with that too. But then at the same time, using it a tool at the same time. I have a program that I educate people on is how to get potentially debt free so you can get a cash flowing asset that covers all your day-to-day operations with a small portfolio of properties. Most people, when they hear that, think that, well, Russell's telling us not to ever have debt. No, I'm just telling you not to have debt on 3 places. That's all I'm telling you not to have debt on. So you have cash flow from those. Over here, where you're buying all these other kind of stuff, lever them up to 120%, whatever you want, whatever it works, right? Whatever the numbers make sense. But it's nice to have a nest egg that produces cash flow that is debt-free on top of something that you have a portfolio of debt over here as well.
Yeah, and it very much depends on your personal objectives. So if the objective is to acquire some assets that you're going to eventually pay off and have the cash flow as your retirement fund, that's a different strategy.
Yep.
Okay? And there's nothing wrong though with keeping the debt on, like I said, letting inflation do the work for you, that heavy lifting. And then later on, if maybe you had 10 properties and you want to consolidate to 3, right? You could do it at that stage in order to get that same effect. That's another way. So it scales a little bit better. But in my case, my younger daughter is very interested in taking over the business. And she's been working now, she's coming up almost to 4 years in the business. And she's learning the ropes and how to do all this stuff. So for me, this is passing on a legacy towards towards her being able to take over the business. So for me, it's not an end game; it's a scaling game. It's basically I grow it, then she takes over, and she can continue to grow it the way that she wants to get it done. So that makes a difference.
And then,
however, I think I would be doing an injustice, Russ, and I think I need to say this just to make sure that I don't get anybody into any trouble. So while I say don't pay down the debt, that I try to avoid paying down debt. I prefer to go with interest only if I can, long amortizations, etc. But we also have to be very cognizant that that loan is going to come due. And if you did it on a 5-year term and you have a commercial asset, so retail's a little different, but if you have a commercial loan and you get to year 5 and interest rates are higher than when you started, which is happening to people right now, then if that interest rate is higher, the amount that the lender will allow you to borrow is going to be lower than it was originally, right? Because of the interest. And unless you've improved it, et cetera. But all things being equal, if you didn't change the revenue line, the net operating income line, if that didn't change in that 5-year period, the lender is going to say you have to pay down some of that debt in order for you to stay within bounds of debt coverage ratio, et cetera. Stuff you understand well. So whenever I take on this kind of debt, I have to think about how I'm going to deleverage before the end of that loan comes due. And that may mean that I'm doing a business case where I'm improving the net operating income. So I'm deleveraging that way. If interest rates are high, I've protected myself, okay, by reducing my debt to asset ratio on that particular property. And if interest rates are favorable, then I can do a refinance and take that money out. But I'm prepared at that point in time. So I think people need to make sure that they understand that, you take out a loan, think about when that loan goes to renew, what are you going to do at that point in time? And think it through.
Nice. Wow. You're extremely aggressive, but you've got your middle name must be risk mitigator. Mr. Christian Risk Mitigation, right? That was your middle name or something, right?
Well, risk management is part of our planning process.
Yeah,
absolutely.
That's something that not a lot of people take into consideration at the same time. But at the same time, if you've managed the risks to the best that you have with the best information that you have, things change, black swans, all this kind of stuff. If you've managed the risk and you're comfortable with it, go hardcore, like get aggressive, like really go for it. Then if you're doing there, if you know your downside and you say that is the worst case scenario, and you plan for it and you manage it, you say everything else potentially can be upside from there, right? Then go hardcore.
You just have to have a plan for it. So for me, I identify what I'm worried about. Okay. So if I'm doing a particular project or if I'm doing an acquisition, right from that very first one that I talked about, that purpose-built fourplex that I bought back in 2005, when I did that week of analysis, I did that sensitivity analysis. I understood what was I worried about? Could I handle it? What was my plan B, plan C? And I do that today with every acquisition. I figure out what am I concerned about? What's the risk? What's the probability of that occurring? What would be the impact if that occurs? And if that's the case, what would be my mitigation plan or my contingency plan? And I write it down. So those moments when we wake up at 3 a.m, we go, holy crap, I'm really worried about this. I'm not sleeping now for another 2 hours and, tossing and turning. Write it down.
Yep.
You're obviously worried about it. Write it down. You get up in the morning, you start working through your risk management plan. You know what? It's going to calm you down. you'll sleep great the next night.
Yeah. It's funny. I had a smirk and a smile as you were talking about those kind of things, and something popped in my head, and I go, geez, that risk mitigation, what can happen? And you're analyzing the gears were just turning, and you had plans and contingencies for something. I said to myself, geez, you must be a fun guy at a party, right? But the funny thing is you were probably the life of the party. I know I've spent some time in social settings with you, and you're a hoot, you're a blast. Like I said, you're a unicorn in many respects. You have that you have that gift of that intellect to really geek out and go really nerdy, but at the same time, you're very personable, and you have a very, sorry, sounds bad. You have a wonderful personality, and you're a wonderful person to talk to.
It makes up for my lack of good looks.
Damn it, you took mine. Well, I guess we better curb this comedy special here that we've got going on here today between Christian and I. So before we do run off here, first and foremost, I wanted to thank you. I want to thank you for your time. And I know, like you said earlier, you don't have a dog in the hunt of coming onto people's podcasts and sharing anything other than just to purely share. Like, that's just where you come from. And I just wanted to offer you a big thank you. Like a thank you from the community, a thank you from people that are listening to this, and thank you for being somebody who is extremely refreshing in a world full of not so desirable characters in some cases, right? You're honest, you're to the point, you're very refreshing on what you do. So just wanted to thank you for all that.
Well, thank you, Russ. I appreciate the compliment. It means a lot to me coming from you.
Yeah. And one last thing I would just want to ask, and I would be remiss if I didn't ask this, kind of the question I ask everybody at the end a little bit is, so if, let's just say we sat down for coffee, downtown after going through and putting on the white hard hats and going through and touring the buildings, because we have to be safety first, don't want to have too many workers' comp claims and the insurance. You don't want to go too high through the roof. After we sat down, after touring one of your properties and we're having a nice cup of coffee, and I looked over you and I said, Christian, I'm feeling stuck right now. I'm just not sure what to do next, where to kind of turn. What advice would you give me if I told you I was feeling a little bit stuck, and how to help me get unstuck and move forward?
Well, I guess it would depend a little bit about why someone is stuck. Sometimes it's a mindset issue, but they know what they have to do. They just need motivation. Sometimes it's skills that they're missing. They may have the motivation, but they're not sure what to do next. I value education a lot. Whether you read a lot, whether you self-study, or whether you take good, reputable courses. And I emphasize the word reputable because it's challenging out there, as you know. And I think there's a lot of really good coaches out there as well. But again, it's a minefield. And I really want to make sure that people, if they're going to take on a coach or they're going to take on courses, as they want to make sure who it is that is, guiding them. Have they done what this person aspires to do? Are they active in it? For example, you want somebody who's truly in the trenches doing work. So you're very active in development. You're doing your business. And so people should learn from people like yourself, or people like Elizabeth Kelly's another favorite of mine. People like Erwin Cito, right? Or they're good salts of the earth. They've made their money in their business, etc. So you want somebody who truly has a credibility. And the warning that I give people is there's a lot of people out there with a shingle that says coach. Okay. And most of these people, and I mean the vast majority of them, really don't have the experience to guide anybody and are likely to lead them over a cliff, as well as, you might get some good advice, but you're probably in a bit of a danger. So,
yeah. Well, if this was Sunday morning, Christian, we would be sitting there going, hallelujah, amen, brother, amen. We'd be singing from the rafters. Well, once again, I thank you. I noticed when we started our conversation, the sun was out and coming in, and now I see lots of car lights, and it looks pretty dark behind you there as well. So I know this is late in the afternoon for you.
Welcome to the winter.
Yeah, and I just wanted to just thank you for your time. It is a true gift that we can sit here and we can listen to and just, they sound weird, but we can bask in your brilliance for an hour and a bit here. So,
yeah. So the red this is me blushing now. So,
all right, everybody, have yourself a wonderful day. Bye for now. Hey, that was a lot of fun. Sure hope you enjoyed this segment from a recent podcast episode. Only a couple simple next steps from here. Number 1, down here will be a link to subscribe so you don't miss any more episodes. And if you're interested in watching more segments from the podcast, click up here. And if you'd like to watch the full episode, there's a playlist for you down here. So enjoy.